What's going on, Investomaniacs? Boy Knight Rider here, and today we're going to be talking about 3 stocks that I would not recommend buying. Up first, we've got Uber. Now, there's only a couple numbers I'm going to share with you, and here's the reason why. When you find a stock that you do want to buy, and the financial statement looks acceptable, okay, good enough, then you got a lot more work to do. But when the financial statement is just like punching you in the face, don't buy this, don't buy this, don't buy, don't buy, don't buy, you don't really need to look that much further than a couple basic numbers. So Uber, for example, has free cash flow negative, operating cash flow negative, operating margin negative 30.5%. That means they're losing a lot of money. And their revenue grew only at 20% this most recent quarter, year over year. Now, 20% revenue growth is good for a profitable company, not for a company that has operating margins of negative 30.5%. Now let's compare that to, say, Facebook, which is free cash flow positive, operating cash flow positive, operating margin positive of 38.6%. Uber is never going to get to positive 38.6% operating margins. You're already getting that in Facebook, and Facebook is still growing revenues faster than Uber. Revenue growth is at 26%. So why would you ever buy Uber? Oh, and by the way, Facebook is super cheap. PE of 27. Don't go make it hard on yourself. Don't try to do something crazy. The answer is staring at you right in the face. Buy something like a Facebook. Don't risk all your money just on fairy dust. That's what Uber is. The business model sucks. Maybe they'll fix it. I'm not saying they can't fix it, but right now it's broken, and there is absolutely zero reason to be in it at this moment in time. Now let's take a look at Uber's little brother, Lyft. Now Lyft is also free cash flow negative, also operating cash flow negative, and has a horrible operating margin of minus 74.5%, but still has strong revenue growth of 95% this most recent quarter, year over year. However, Uber used to have a lot stronger revenue growth. And then what happened, right? It got more to scale and revenue growth slowed down. And how do the numbers look now? Still horrible. These two companies do basically the exact same thing. All right. Lyft is it's going to be Uber in a few years. And we still don't want Uber. So there's zero reason to be in Lyft. But I know some of you are like, all you see is that 95% revenue growth. Okay, so fine. Let's take a look at Carvana. Carvana is also free cash flow negative, also operating cash flow negative, has operating margins of only negative 10.5%, which is way better than negative 74.5%. And yet it's actually growing revenues quicker. Revenue grew at 110% this most recent quarter, year over year. So again, why would you ever buy Lyft? Guys, just don't mess around with it. Don't make investing more difficult than it needs to be. So choose something like a Carvana if you really need that super high revenue growth. Now let's talk about Beyond Meat. Beyond Meat is a different situation because Beyond Meat is actually a good company. It actually makes sense. It's a good business strategy. Everything's it's good, right? The management's doing a good job. They're growing super fast. Everything's doing good. Operating margins are under control for the amount of growth they have. This is a different situation. It's just too expensive. The valuation is too much. It's the fact that they've done such a great job that everybody is buying up their stock, and it's just pushed the stock up to an unrealistic valuation. So the stock is currently trading at 79 times trailing 12-month revenues. However, when you have a company that's growing revenues at 215% a year as of its most recent quarter, I like to look at the last quarter and then annualize that revenue. So in that case, we're trading at 57 times revenue, which is obviously still super, super expensive. Now, this is kind of like a getified version of a PEG ratio. we're not profitable, so obviously we can't use earnings. So in that case, we're going to do the price divided by revenue, and then we're going to take that number, which is 57, and we're going to divide it by the revenue growth, which is 215, and we're going to come up with 0.265%. So it's the same concept as a PEG ratio. The lower the number, the better. Now let's take a look at Carvana. So this stock is trading at only 3.7 times trailing 12-month revenue and only 2.9 times last quarter's revenue on an annualized basis. Now, it is growing a lot slower at 110%, but obviously, listen guys, if you have so little money that you can't make enough money with 110% revenue growth, you need to stop investing and you need to go work and get a normal job, because 110% revenue growth is more than enough, all right? Plus, I'm sorry, I mean, the fact is, I don't mean to use Carvana again. It's just that there's not that many companies that are growing revenues at 215%. So, and then even beyond that, there's a lot less companies that are growing revenues triple digits that I actually would recommend on some level. So, sorry to use Carvana twice. It's just there's very few companies that are growing triple digits in terms of revenue, and I'd recommend them. So I kind of have to use Carvana again. So this stock is the kind of like the getified version of this PEG ratio, but using revenue instead of earnings, is 0.026%. Remember, so Beyond Meat is 0.26. and Carvana is 0.026. So Beyond Meat is 10 times as expensive when you take revenue and revenue growth into consideration. Of course, the PEG ratios, and this is the same concept, are not 100%. There are issues with them, and you might want to watch my kind of advanced stock training video on the PEG ratio if you haven't already seen that, or if you aren't already familiar with the downsides to PEG ratios. And Carvana also has a superior operating margin at minus 10.5% compared to minus 22.6%. Now, I want to get one thing straight. This operating margin is perfectly fine for the amount of growth they have. It's good. It's mostly the valuation. Now, I did want to do a second comparison for Beyond Meat because the growth rates are so different. I just wanted to show it from a little bit of a different standpoint for why the valuation is the primary problem here. Now, the revenue for Beyond Meat is about $161 million. That is that last quarter on an annualized basis. And our market cap is $9.11 billion. And so our market cap divided by the last quarter's revenue annualized is 57. We kind of went over that last time. And Tyson Foods, which is the largest beef producer in the United States. So this is kind of what Beyond Meat is going for, right? They're trying to become number one in the United States, a big established player, except in the vegetarian space. So only about 3.2% of the United States is vegetarian compared to 96.8% which eat meat. Now, if we account for the population difference, that means that there's only a 1.34 billion maximum revenue potential. So remember, Tyson brings in 40.7 billion, but they're serving 96.8% of the US population, plus international. Beyond Meat, it's only 3.2% vegetarian. So when you adjust for the percentage of the population you are addressing, your maximum revenue, because Tyson Foods is number one in this space, in the meat eating space. They are the developed number one player. So if Beyond Meat became that in the vegetarian version, it's still a maximum of $1.34 billion maximum revenue. Now, there are some adjustments we can make. So if we assume a 3 times favorable maximum revenue, I know this is like not worded super well, but we're gonna go ahead and triple the maximum revenue for some of these reasons. So for example, some meat eaters will still eat Beyond Meat even though they're not fully vegetarian. So therefore they kind of have a larger potential market. Also, Beyond Meat may have a larger market share than Tyson Foods. So we're really kind of going out of our way to give them every single possible advantage and say, okay, you're going to get to number one on a nationwide level once the market is developed and you're running full steam, and we're still going to say you're number one and you have an even more significant market share than the number one market share in the meat space. And we're also going to account for the fact that that vegetarian meats do tend to be more expensive, so therefore that will equate to more revenue, assuming the same amount of people are buying it. So if you account for all those things, you 3x the revenue. Now we come to a maximum adjusted revenue potential of 4.02 billion. Now, let's also take into consideration that the population is slowly shifting from meat eating to vegetarian, so therefore it will have a higher sustained long-term growth rate than the meat eating companies, which will not be growing as fast or potentially even shrinking at a certain point. So we're going to go ahead and allow a 50% higher market cap to revenue valuation, which is then going to bring our market cap to rev valuation to 2.04. So you multiply this by the maximum revenue, and it's going to bring you to $8.2 billion market cap maximum, assuming everything goes right. Everything goes right. And that is still less than its current market cap. So obviously this is not the way the stock trades in the real world. In the real world, there's investor sentiment and there's momentum trading and there's technical trading and all this stuff. But from a fundamental basis, I just cannot make sense of this in terms of, obviously the revenue growth is going to slow down in the future, right? It's a little small company right now, so it's going to be able, even though it's like a $10 billion market cap, in terms of where their revenue is, it's not that big of a company. So yeah, they can grow quickly now, but guys, they're going to satiate this market sooner or later, and revenue growth is going to, and then we're going to start to having to face real world valuation metrics, and it doesn't look really good for me. So that's why I can't get behind Beyond Meat. But again, I like the company. I think it's a good company. It's just I can't get my head around that valuation. Hey, hope you guys have a great day.